morning and welcome everyone to the Money Control live stream. You're watching the opening bell and I'm your host Nikki Mirchandani. Get to the basics. Smart recovery seen in the previous session. Indian equities, however, set to add on to gains post previous session. Smart recovery. Previous session price action is a massive boost for the bulls. However, if we talk about the setup that we're looking at for today, trends in Bank Nifty indicate a positive start for broader index with gain of more than 0.3%. US futures were little change in Asia after S&P 500 rose by 1% on Wednesday to close about 5,000 points. Asian shares rally, shares in Japan, South Korea advance. Well, Wall Street, of course, saw some action, but Nvidia displaced in Alphabet as the US stock market's third valuable company. Talk about FIIs, well, they've sold shares and the amount is big, 3,929 crore. That's something that we need to really take in perspective there. But DIIs have purchased equities also supporting in the market to a levels of 2,897 odd crore. Stocks that remain under F&O ban, well, addition is Hindustan Copper. There is no deletion there. What has been retained are some of the names, which includes Aurobindo Pharma, which remains in that list. Balrampur Chini, Bandhan Bank, Delta Corp. These are some of the interesting ones. Nalco also, after the sharp price action that the company, or rather the stock, has been witnessing over the past few sessions. SAIL and Z Entertainment also have been retained in that list. Of course, the big mover or the big news of the day actually are three. Vedanta, which is the promoter, is in talks with GQG Partners to sell $1 billion worth of stake. Now, this is a ET report. The final talks for potential stake sales have already been taken and the transaction may take place in a few days in the form of block deal. That's the ET exclusive that we are picking in. RIL also is in talks to buy stake in Tata Play from Disney. The move is broader strategy to deepen footprint in country's TV distribution sector. Overall, Tata Sons, the holding company, holds around 50.2% stake. But that's the two big news. Of course, clarification also coming in from Paytm over submission of documents to ED over a point of time or over a period of time. But let's cut across straight to Chandan Taparia from Motilal Oswal to talk us through the trade setup for the day, top recommendation and the strategy one could look at for Bank Nifty. Morning there, Chandan.
Good morning, Nikki. Thanks for having me.
Pleasure.
So we have seen a strong run-up in the market. In last trading session, the index, which opened negative, managed to hold 21,530 zone and witness a tremendous recovery of more than 350 points. And we believe that bulls are back on track after the consolidative movement of last 7-8 trading session. And with the support of 21,650, 21,700, this rally could extend towards new lifetime high of 22,126, 22,222 zone. So we will be positive with the view that index has potential to head towards the new lifetime high territory. Now, talking about Bank Nifty, after the roller coaster ride of last couple of days, finally the bulls are holding and having the dominance. We believe with support of 45,500, Bank Nifty index can head towards 46,500 to 46,750 zone.
Chandan, I'm sure you've noticed the trend that it is RIL along with State Bank of India. Though State Bank of India really does not have much weightage in Nifty, but RIL has been supporting of the markets and rather negating the fall that otherwise HDFC Bank has been witnessing. What's your assessment on RIL, Geo Financials? There are a couple of developments which are taking place for these companies. What's your assessment there?
Yeah, positive view on Reliance Industries. This stock has really turned as a bullish sentiment to drive the index. It is continuously making high top, high bottom on the weekly chart from last 16 weeks. On last trading session, it gave the fresh breakout, and we believe that the way coal unwinding started to happen at 2,900 and 3,000, momentum could accelerate. So one can buy Reliance Industry with support of 2,900 for an upside move towards 3,050. Positive on most of the PSU name, and we like SBI for next leg of rally. We believe that till it holds up 725 zone, State Bank of India has potential to rally towards 780 to even 800 zone. So one need to remain bullish with banks and especially in the PSU banks in the market.
Okay, if one was to enter the stock right now, RIL and SBI, what would serve as an entry points for these ones? Because we've seen significant rally already taking place for SBI, and so is also the case for RIL.
Yeah, so you can wait for a small dip. I don't know whether the dip will come or not. But yes, as of now, 725 is the best entry zone with support of 700 and rally for 800. Reliance Industry, and what I believe that in this market, the stock which are in momentum likely to catch the momentum further. Even in Reliance Industry, if you get a dip near 2900 or 2920, that will be the best area.
Okay, though you see that unlikely, but 2900 is the level that one could look at lapping up this counter. But there is a headroom both for SBI as well as RIL. HDFC Bank has been got some serious disappointment there. But to bear in mind the fact that HDFC Bank has seen mutual funds picking up 13,850 crore shares in January. This is the market which is driven by DIIs. Mutual funds have been the biggest contributor here. And just when you're seeing serious dropping coming in HDFC Bank, guess who is buying? Mutual funds. Okay, that's the story of the smart investors there. But Indian investors have behaved extremely smart in previous session. And that's something that we need to really highlight, the fact, the smart recovery texture perhaps point out to the fact that this is a buy on dip market. See the support level coming in on 21,500 level. But let's address in the markets open right there for you. We were looking at a start coming in to an extent of 0.3%. So 0.25% is what we have clocked in early deals. And 21,000, nearing that 21,900 mark is what we're looking at in early deals. Let's also talk about Bank Nifty index. Well, a bit of a flat start coming in for Bank Nifty, nevertheless holding their neck above the water. Almost gains to an extent of 0.1% for Bank Nifty. Remains to be seen if further support is lent by Bank Nifty. But that's again a story that we'll discover through the course of the day. Mid cap and the small cap index, which were rather beaten down in blue, have now seen some amount of recovery too, right? Mid cap is trading higher with gains to an extent of 0.5%, and small cap perhaps acting no different and attuned to what mid cap index is doing at this point of time. Let's pull up PSU Bank, and post that let's look at RIL. PSU Bank, look at that. We're seeing steady amount of gains coming in for that one. Almost 0.5%, like Chandan was highlighting. You know, he would want to be in the PSU banking space, especially bullish there. He's also picked up SBI and also given the levels out there for SBI. But let's pull up RIL, because that's where the support is coming from, right? 0.2%, nearly thereabouts for RIL. Of course, there is a development of Tata Play. The advanced talks of deal with Disney, which is about to take place, or rather remains to be seen, would be clocked in the month of Feb. So there is fair bit of traction and development taking place for RIL. State Bank of India next. Though the weightage is not really too high in the index, but that's where some momentum has been clocking in. But 0.1% of loss coming in from SBI. Well, probably an entry point. I would cut across to Chandan in some time and check with him what does he make out of State Bank of India. But top gainers and the top losers on the screen for you. Just a point. Well, we're looking at M&M, NTPC and Wipro. These are some of the top gainers that we have. Coal India, UPL and BPCL. Well, some of the other top gainers, HCL Tech, ONGC, TCS. After the sharp, profit booking which came in the IT sector, recoveries which is only anticipated at this point of time. Much of support being lent in by the defensive name also. Let's actually flip across to the top losers, just to see where actually there is fair bit of profit booking, and no surprise for guessing there. Financials along with FMCG. Axis Bank, Nestle India, HUL, Ultratech Cement, Kotak Mahindra Bank, Apollo Hospitals. Well, these are some of the top losers. ICICI Bank, Britannia. Like I said, it's just a mix of banks as well as FMCG, which actually are not really participating well at this point of time. Chandan, coming back to you, what do you make out of this? Your strategy now, would you suggest a buy coming in for State Bank of India, which has actually reversed the trend now to trade a bit higher? That's one. Also, IT stocks are seeing fair bit of recovery on ground. Would you suggest lapping up any of these names? And financials, a bit of pressure there. What do you like from the PSU space apart from SBI?
Yeah, so if I look at the Nifty PSU index, Nifty PSU index heading to the new lifetime high territory. We have seen good run up in State Bank of India and is likely to be the preferred name as well. However, same setup is clearly visible in Canara Bank or counter like Bank of Baroda. So I think we can continue to be with SBI, can wait for a small dip. Right now trading near 746. Any decline of 10 points could be utilized as a buying opportunity for next leg of rally. Apart from that, we have positive view on most of the auto name. We talked about Maruti. You can also look at the Tata Motors. Tata Motors is now turning up after the decline of last 5-6 trading sessions. So here you may get the better risk reward ratio because major trend is intact to positive and recently it has corrected from 950 to 895 zone. So one can buy Tata Motors with support of around 900 for an upside move towards 970. So apart from SBI, you can look at the selective auto name as well in the market.
Okay, Tata Motors is the fair bit of recommendation coming in there, but also in terms of IT, do you like anything from that space, Chandan?
Yeah, so if I look at the Nifty IT index, Nifty IT was slightly underperforming due to the weakness in the global market, especially how the Nasdaq performed. But yesterday the recovery was tremendous, and today the follow is clearly visible. So positive on most of the IT name. We would like to recommend on BSoft, one of our preferred name and one of the outperformer name in the count in the market. So with support of 835, you can see an upside move towards 875 and BSoft.
Oh, you're talking about Birla Soft, right? Okay. Anything else, Chandan? Apart from that, persistent KPIT, anything that looks favorable at this time?
Yeah, I can look at the Bank of Baroda if you want one more name in PSU space. One can buy Bank of Baroda at current level with support of 265, and here we can see an upside move towards 280 level. So SBI, Bank of Baroda, Tata Motors, these are the couple of names one need to keep in mind during the day.
All right, Chandan, we're just going to leave it at that. Thank you so much for taking out the time and having this conversation right here with us. All right, enough and more needs to be covered, right? Even on the fundamental side of the story. Let's cut across straight to Anshul Saigal, the market expert who joins us to give a fair share of handover of what does he make out of A, the entire Q3 earnings, what stood out for him, what was hit, what was a miss for him, and the sectors going forward. Morning there.
Morning, Nikki.
How are you doing?
I couldn't be better, thank you.
All right, seems like fair bit of recovery which has taken over the markets. Smart recovery, I would say, that has come in previous session. Today's day also is no different. We are adding on to gains after fair bit of correction that mid cap and the small cap indices have witnessed this far. A very broad aerial view for the markets right now. You think it's just a phase of consolidation before we could hit the pre-election rally, and also your view on the mid cap and the small cap indices right now?
Nikki, while I do have a view, and all I can say is that any view on the markets is to be taken with a pinch of salt, because really it's very difficult to predict market directions. Go back about 12 months and I can tell you that if you spoke with fund managers or general people on the street, they would have told you that markets are expensive, stay out. And we know what happened. Over 12 months, the small cap index went up 55% and more. So clearly it was not something that anyone predicted. And if they were not able to predict the last rally, which was so significant, who is to say that if I tell you something today, then I will be able to predict it 12 months from now? Very tough to predict market moves. What you can, of course, do is keep an eye on what's in your control. What is in your control is to identify good businesses and buy them at reasonable valuations. If you've got that right, then irrespective of market moves, over a period of time, you will make money. Of course, in the interim, you may have to bear volatility, but over a period of time, you will make money. Having said that, this result season it has so far gone on quite reasonably well. We've seen companies outperform in general, or at least meet expectations or outperform expectations in general. And there are certain segments, for instance, FMCG, where you've seen misses on expectations. But take oil and gas, take capital goods, take PSU banking, real estate. These are some segments where pharma, for instance, where we've seen beats on expectations, and we've seen stocks react to these beats. Now, I'm someone, and I'm a votary of taking signals from stock prices. And I can tell you that, for instance, a company which is in the space of outsourced electronics, that reported earnings recently, and that company witnessed on 2 days after its reported earnings, it witnessed a significant downfall. I mean, from somewhere close to 4,400 rupees, the stock went down to 3,400. And then the call happened where they gave a fair understanding of why the numbers came weaker than expected, and why they believe that in the future there is going to be strength in their business. The stock has rebounded quite handsomely from those lows as a result. Now, this ticker action doesn't indicate that there is a widespread weakness in the market. And I can give you example after example where such ticker action is playing out. It does look like the market is not in a mood for a broad-based rally, but that if outlook for stocks and if numbers are strong, then stocks will be re-rated even from here. That is my general view of what's happening this result season.
Okay, what really stood out for you, if you could put out the names to this in terms of the stock price performance like you were highlighting? That's one. Also, do you think there is more strength now within PSUs? And when I say PSU, I think most of the street is now gung-ho on PSU banks rather than any other theme which is existing in PSU. Do you have any different view there?
No, I'm in the same camp, Nikki, on PSUs and PSU banks in general. If I look at that space, and in fact, you'll have to take a longer term view of that space to understand it well. Between 2014 and 20, across the board, PSU banks got derated quite significantly because NPS went up and growth slowed down. Now, that was the peak of this downward cycle. Post that, NPS started coming down and earnings started going up. Of course, in this period, many of these banks shored up their capital base. Now, having seen that sort of a cycle and valuations at 0.2, 0.3 times price to book, it's hard for the markets to fathom that today these valuations are trading somewhere close to 0.8 to 1 time book. But even this number in the long term has, I mean, if you look at 15-year valuation cycles of these banks, this number of 0.8 to 1 time book is cheap. These banks have traded anywhere from 1.5 to 2 times book. And if we believe that this credit cycle has legs, then it is quite likely that earnings keep compounding and these banks get re-rated further. Also, on price to earnings basis, throw a dart and you'll pick a bank which is trading at 5 to 10 times price to earnings ratio. That doesn't look expensive for growth of north of 20%. So, in our judgment, PSU banks have legs. And this rally has yet not ended. It's somewhere in the middle, but there is further room to go. Okay. Regarding your first question, I think the company I was referring to there was Amber Enterprises, and I can name so many other companies where on strong results, take Action Construction Equipment, strong results, stock did exceptionally well. So many other companies where
don't you name us a few companies which according to you actually stood up or stood out in terms of their earnings action, but the rally is rather not captured by the stock, which actually could serve as a good entry point for our viewers?
Nikki, I won't name names there, but I can tell you that in capital goods, there are many companies where this thing played out. Certain pharma companies where this played out, where numbers were stronger than what our expectation was, but that didn't reflect in stock price. So, I mean, of course, people will have to do their own hard work and go and listen to calls. On my suggestion or my indication of such names, they will be not convinced about going out and buying these names. So I think that These are broad segments where opportunities exist. Oil and gas, I think that's where opportunity exists again. People should just go out and read as many transcripts as possible. All of that is in this day and age available on websites, and take their own calls.
Well, let's actually understand in terms of PSU banks. According to valuation, what looks attractive, or let's just say which is fairly priced at this point of time in the pecking order at least. I understand that you'd not want to put a finger to just one stock and say that this is the recommendation. That's not the motive here. Just in pecking order, in terms of valuation, what do you find attractive?
One is that scale benefits are generally underappreciated. So some of the bigger PSU banks, take the case of SBI, Bank of Baroda, Canara Bank. These are banks which have scale benefits. And while some of those scale benefits are in the price, but really not fully. So, some of these banks can be considered or at least researched more to figure out whether these kind of match with one's investment style. And of course, the lower down you go on the PSU banking space, the more careful you will have to be with not only valuations, but also quarter-on-quarter volatility. That is something that in the larger banks, you can be relatively less concerned about. So I would say that the larger PSU banks, some of the names that I took, and some others are the ones that investors could still research and study.
What's the trend playing out for private sector banks? And the reason I ask you this question, I'm sure you'd assume that it's about HDFC Bank, which has seen fair bit of correction, which is already, which has tipped out the stock quite a bit. But mutual funds, on the other hand, the Jan data suggests that they have been lapping up HDFC Bank, and that's by a huge margin. There was a Jefferies report which suggested that, relatively, if you look at the feedback that FIIs have been giving, they aren't really that pessimistic. If one was supposed to look at the stock from a year or two point of view, do you think it's a good stock to hold, or you think perhaps more pain is in the offing for this one till the time the amalgamation or the synergies could completely take over for this one?
So if I was to do an intellectual analysis of this one bank, I'm not recommending anything. I don't own it. There is no there is no skin in the game, so please take my words just as an intellectual assessment of the situation. I think that this is, if you look at valuations, I don't remember a time when the bank traded under 2.5 times book, and it trades at somewhere close to 2.2, 2.3 times book. On price to earnings basis, I think it trades at 12, 13 times price to earnings. Again, I don't remember a time where it traded cheaper than Nifty. And Nifty trades, as we all know, at 20 times forward earnings. So there is a significant pessimism that is already built into the bank. And this pessimism is because of good reason. The CD ratio of the bank has been quite adverse at 110%, which means that the bank is growing credit much faster than the deposits that it is growing. And as a result, the net interest margin has compressed for the bank for this reason. Now, the question is whether these adverse developments are already built into the stock price or not. At these valuations, much of that pessimism, much of that adverse movement in fundamentals seems to be built into the stock price. But then there is a technical factor, which is that for the better part of last 2 decades, FIIs and domestic investors have bought into HDFC Bank, and so there is relative over ownership. And as a result, when numbers don't play out in line with expectations, these buyers come in and these holders of the stock come in and sell, which is the phenomenon playing out with such over ownership. The bank is being sold by large investors, and that's putting pressure on the stock price. At some point, both these factors will balance out and the stock will bottom out. I don't know if that's going to happen in the next 3 months or 6 months. But clearly, if this was to go back to previous valuation levels, and this is not just any bank, of course, it's a quality bank, quality sales force, quality management, then the bank has significant upsides from here. On the downside, of course, much of that is played out. Some more may be left. So risk reward doesn't look highly unfavorable. The question to ask is, can I put my money to better use elsewhere over HDFC Bank in the interim? That's an answer that each individual will have to give to themselves.
All right, point well taken and also made there, I would say, without giving in too many details. But let's talk about pharma index. Of course, you've spoken about capital goods, you spoke about pharma. Within the valuation ambit, what you really like, and also IT, right? Pharma and IT have been the two index which rather have been supporting in the markets, at least for the month. It's a short-term view, which of course have gotten some support there after the huge correction that has come through on the mid-cap and the small-cap index. But now at this point of time, is this juncture, the valuation perspective for pharma, and do you like IT space?
Nikki, in pharma, what happened again between 2014 and say 21, or even 22 with the blip of the COVID period, is that we witnessed a one-way movement in US drug prices, which is down. And as a result, all exporters of pharma from India to the US witnessed margin contraction, and that led to ROE contraction. And this came in a period where pharma valuations were really at never seen before levels. Many of the pharma companies were trading at 35, 40 times price to earnings. So what happened as a result is, for nearly 6 to 7 years, we witnessed a multiple contraction in pharma. Now we came to a level over the last 1 year where there was really no room for drug prices to go down in the US. And if the prices went down any further, many companies supplying to the US would go out of business, and hence they backed out of the market at those prices, which meant that there was shortage of drugs in the US. And to make good that shortage of drugs, prices needed to stabilize or go up. That phenomenon is what we have seen over the last 6 to 12 months. And with that happening at a time when valuations have consolidated over the better part of 7 years, what that meant is, as ROEs expanded, as earnings growth came back, many of these companies witnessed multiple expansion. We saw that cycle play out to some extent so far. If you look at the largest pharma company, Sun Pharma, which is which really drives interest in the sector, that company has broken out of its all-time highs after nearly 7 or 8 years, maybe even 9 years, and numbers are after a really long period of time beating expectations. So that is really, and I can give you example after example in the pharma space where this trend is playing out. I think that this is an indicator of things to come. We believe that, again, in this space, to ensure that you don't have to worry about volatility, if you don't have the wherewithal to do extensive research, then stick with the larger players, the well-entrenched companies with good management. And that's where you will witness relatively less volatility going forward. This space is ripe for a re-rating. Price action tells you that interest is likely to only go up from here. And so this is a good space to be in, pharma in general. Of course, there are many segments, but in general, pharma is a good space to be in the times to come. In IT, IT has become actually a macro trade. The way investors are playing IT is that they are taking calls on the US investment cycle, US interest cycle, and extrapolating that on IT. What that means is that if they believe that the interest rates are going to be benign, they believe economic activity will pick up, And as a result, IT will benefit because there will be more business for IT and vice versa. Now, between 2021 and 23, we witnessed a down cycle for IT because interest rates were going up. Now that interest rates are becoming benign, or expectation is that they will become benign in the US, investors have again seen interest come back to the IT space. I must say that I'm not very comfortable with valuations of many of the IT companies at this time. So I would play IT not as a broad basket, but I would play IT as a sector where in general there will be interest, and where if I can find special situations, that is whether there is a management change or some change in the business dynamics of a company, which is leading to greater order inflow and margin expansion on a company specific basis, that's where I will have interest rather than looking at IT as a broad basket. And let me tell you that there are many opportunities which offer this kind of a makeup in IT. Look deeper, dig deeper, and you will find those opportunities. So IT is a sector, is a stock by stock opportunity, to my understanding, rather than a broad-based sectoral opportunity.
I would have completely loved to quip you on more valuation perspective within the IT space, but we're completely running out of time in this edition. But I'd like to thank you for taking out the time and having this conversation and offering that different perspective to us.
Thank you very much. Thank you, Nikki. It's my pleasure.
Welcome. Well, that's all that we have on this edition. With this, it's a wrap, and goodbye from the entire team who puts this piece literally together. Thank you so much for watching, and please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and for rest of the updates, stay tuned to moneycontrol.com and Money Control app.